Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to cover the latest oil and gas and mineral rights news for January of 2025. So, Justin, first of all, Happy New Year. The year is off to an interesting start already.
You said it, Matt. No lack of news to talk about. Everybody is talking about what's going to be coming in 2026, and we're full of stories about that.
Yeah, we'll talk about that and what hopefully the oil markets will look like. And, time will tell, but we have the early prognostications in as the first few companies have issued guidance for 2026 capital budgets. We'll talk about what the drilling activity is likely to look like. And then, some more geopolitical stuff, which seems to be always the case here. But before we get into that, I saw this first article and I figured we'd talk about it because it was something that I hadn't ever seen before. And what the article is about is the GSA is auctioning about 133 acres near Big Spring, Texas, as part of a public auction of the oil and gas mineral rights. So the GSA is the General Services Administration, and this auction is part of a strategic disposition of surplus federal properties. And the quote says, GSA is proactively divesting underutilized assets, in the public auction sale of mineral rights in Big Spring is a prime example of our dedication to delivering the best value for American taxpayers, said GSA Acting Administrator Michael Regas in a statement. So this one's an interesting one, Justin, because I've always heard of government auctions going through EnergyNet. So, for example, the annual lease sales that the BLM does, those always go through EnergyNet, but this is actually through a direct government website that they're holding this auction. So this was a new one for me.
Yeah, it is interesting to see it, Matt. The GSA, when they launched that platform, I was in the private market, and it was a big deal because they switched all of the processes for having some kind of online store for the government. But I've never seen land sales necessarily be a part of that. So it's really interesting to see them include that. I'm sure there's some savings for them on their part, but I wonder how smooth this is facilitated and, compared to a private company like EnergyNet, how well they'll actually do this process.
Yeah, exactly. I mean, I guess online auction sites are nothing new, so maybe that technology is something they were able to replicate or to do in a somewhat efficient basis. I checked out the website just briefly to take a look at it, and it looks like there's pretty similar interface, but something to bookmark, I think, if you are a mineral buyer and you're interested in these types of auctions, because this is, in Howard County, Texas, which is in the Permian, and it's I didn't look at the details, but to get a tract of, 50 net acres or 100 net acres, that's a pretty good chunk. And to be able to get that in, one transaction is, I think, very desirable for the mineral buyers out there. So certainly something to keep an eye on as far as the GSA. Maybe there's other federally owned minerals in desirable areas that'll come up for auction, in the near future as well. So definitely worth checking out.
Yeah, you said it, Matt. It'll be an interesting new outlet to keep an eye on. And our next one here was kind of an interesting story to me because the numbers it talks about in the article they sound like big numbers, but it may not have as much of an impact as the story kind of leads you to believe when it comes to if it might be a way that oil prices are impacted. And so the article is about U.S. pressure on Venezuela disrupting the oil exports and tankers diverting. So that there's a lot of crude piling up on sea. And obviously in a situation like that, once they reach their maximum storage capacity, they're going to be looking at shutting in infrastructure. And that's not good for anybody. The article says it's about $8 billion in oil revenues. The global markets remain largely insulated for now, but they're warning that prolonged disruption could deepen Venezuela's output losses. And so, Matt, what's your feeling on this article? Again, we kind of talked before we hit record that maybe it's not such a huge percentage of the, daily output on a global stage.
Yeah, exactly. When you look at the global oil output, it's about 100 million barrels per day, a little bit more than that, but let's just say 100 for the sake of doing an easy calculation. The Venezuelan exports or production. I think you'd done some research, Justin, before we hit record, and you'd mentioned a number of 500,000 barrels per day is what they could lose, according to a Reuters article. And so that 500,000 barrels per day is 0.5% of the global oil production. So it's a very small percentage. The number, that $8 billion oil trade that the article refers to, is best we could tell based on that 500,000 barrel a day impact. That would be roughly the total production, or the value of the total production from Venezuela in a year. So it must be the $8 billion in annual oil trade that is going to impact Venezuela if this keeps on for that period of time. So certainly a lot of money at stake, but relative to the global market, it's pretty small. And the article mentions here, this all started with one tanker seizure, and everybody by now has probably seen the video on the news where the Special Forces soldiers, rappelling from a helicopter onto a tanker and then seizing the tanker. And the quote is that, quote, oil, land, and other assets that they previously stole from us. And then most likely referring to oil assets nationalized by the Hugo Chavez administration back in the 90s. And President Trump also wrote on his social network that the military presence off the Venezuelan coast could only get bigger, and the shock to them will be like nothing they've ever seen before. So this kind of came out of the blue to many, I think, as far as the, what the impact of Venezuela is having on the U.S. from whether it's drug trade or, those types of things that are what is maybe mentioned in some of the articles. But ultimately, there's got to be something deeper behind this. And so I think it's interesting when you look at these articles, they say that, well, this is, certainly related to some surface value thing like us getting access to their oil. And, honestly, if we really wanted that, we could have access to it on the market, just through diplomacy and getting some deal done with Venezuela to get access to that oil to help Gulf Coast refineries that are designed to process a lot of heavy oil. So there's got to be something behind it, I think, Justin. I don't know. What is your take?
Yeah, I think there's got to be more going on. And, this is not unlike the pressure that was applied to Russia either in the Ukraine situation. This is a main source of income for them. And, it's hard to continue operations if you don't have that cash flow that was expected. But Matt, there was some, back and forth on what the impact really would be about completely shutting off Venezuelan crude. And so the Gulf Coast refineries are kind of what's at risk there. And it could be a disruption for them because they do use that in some of the blends and would need to replace that.
Yeah, for sure. There's definitely, there's that demand for that heavy crude, which Venezuela produces heavy crude. So there's probably an element of that for sure, and getting reliable access to that crude, in the Western Hemisphere for sure. But it's interesting, so there was an article today actually in Doomberg. So Doomberg is a newsletter that is subscription-based, and they have a lot of detailed analysis on energy markets and minerals and all the things, like related to the bigger picture and what's really behind the scenes on these types of stories. And they had a very interesting take to this and saying that there's got to be more to it behind the scenes. And I would tend to agree with that. And they suggest that the muted response by Russia and China is telling in and of itself that maybe there's something else going on with respect to our relationship with China and Russia as it relates to Venezuela. So in other words, the gist of it, and you definitely have to, I highly recommend subscribing to this newsletter. They have really good takes. This one, at surface value, they're saying it's not just about Venezuela, but it's more about the broader political, landscape as it relates to the West. And one of the things they referred to is the National Security Strategy Report, which is just recently released by the Trump administration. And one interesting take from that is that they say, quote, after years of neglect, the United States will reassert and enforce the Monroe Doctrine to restore American preeminence in the Western Hemisphere and to protect our homeland and our access to key geographies throughout the region. We will deny non-hemispheric competitors the ability to position forces or other threatening capabilities or to own or control strategically vital assets in our hemisphere. So I think when you look at it from that perspective, the fact that the Trump administration, one of the key points was to try to negotiate a ceasefire and a truce between Ukraine and Russia. And then, the trade war with China and trying to get on terms there. Perhaps this is something. There's been some deal going down as far as how we would have more broad access to the Americas and the Western Hemisphere, and then kind of leave China and Russia to deal with the Eastern Hemisphere. So I think that's a pretty interesting take, and I think there's probably some level of truth to that at the end of the day. But I guess we'll probably never know until many years down the road.
Yeah, you said it, man. It'll be interesting to kind of watch the situation evolve, though, and I don't think it's going to be, much of an increase on the oil prices or have much of an impact there, though it might sound like it's big numbers. I know that was kind of one of the thoughts that I had when I initially skimmed through it. Matt, the next story here is about the Waha gas prices and the rebound that's happened there as maintenance eases at Roswell and then elsewhere. And so the Waha cash hit the punishing lows over the weekend, the period from December 13th to 15th, sinking to an hour price of minus $6.08 per MMBTU, according to data from the Natural Gas Intelligence. And Matt, that's obviously really concerning. And we saw this for the first time ever. When was that? In 2020?
Oh, yeah. I think it's been certainly going negative for some time. But yeah, definitely in that time period. And then since then, just because of the amount of drilling that's gone on and because of all the natural gas that's produced as a byproduct of oil production, the production has exceeded the takeaway capacity in the Permian Basin. And so that Waha hub is where gas is traded at the Permian. So it's been kind of hovering negative for a good part of the year. It kind of pops up positive, but it's, certainly nowhere near, if you look at like Henry Hub or other parts of the country, the prices that they're getting paid, it's well below that. So yeah, the article mentions that the Henry Hub had averaged $3.88 per MMBTU over that time period. So that's almost a $10 difference between Henry Hub and Waha Hub, which is insane.
Yeah, you said about there was a lot of concern with the amount of flaring going on, and with prices like this, it doesn't help that any. I wonder if we're seeing the lower prices because they're doing less flaring, or if that's still a problem that's going on. Because prices like that, it's difficult, and I know there's a lot of constraints with also moving that gas. There's not enough infrastructure to really move it efficiently.
Yeah, and anytime you see disruptions, when the market is so tight like this, anytime you see a maintenance issue or disruption on a pipeline, like a compressor station goes down, or in this case, this particular El Paso pipeline, we're basically a big culprit in this extreme drop. So these couple of pipeline systems, one taking it to the east, one took it to the west, and there were similar, constraints at the same time, whether it was maintenance issues or whatever, and that kind of perfect storm causes prices to tank. And so that's where you get, you're on this very razor thin margin of, everything has to be working perfectly for prices to be somewhat even stable or marginally positive. And then if, a compressor station goes down or something happens and they can't export as much gas, then the prices, go below zero. So the impact here on royalty owners is certainly felt directly in our pocketbooks, because it means that generally, when these events happen, we get negative gas prices, on our royalty check. So basically they're taking money out of the oil proceeds that we get because gas was negative. So this hurts royalty owners as well.
Yeah, you said it, Matt. And it can have a large impact, depending on the price of oil. And right now is a time where we're not seeing really high oil prices. All right, Matt. So I think the next one is definitely the most interesting one. And it talks a lot about what we foresee in 2026 and what companies are going to be doing about expenditures and how much drilling they're going to be doing. And I think it's kind of, par for the course to some degree, but also some really interesting information in the article. There's a lot of political pressure, or we thought there would be, to drill, baby, drill. But that just doesn't really seem to be the mindset that these oil companies are in. They've wanted to return to shareholders, which they've focused on that throughout 2025. And they're trying to stay within cash flows and not be in a boom and bust situation.
Yeah, that's a great point. I think that the entire market and the CapEx projections for 2026 won't start coming out really until after the new year. So I'd say this quarter, the first quarter of 2026, we'll get a better idea as companies do earnings reports and guidance for the spending for this year, and then we'll see what their plans are. This article, and we'll link to it in the show notes, it talks about CapEx or capital expenditures on a per barrel basis or per barrel equivalent basis. And so because of that metric, obviously, the level of spending is higher for companies with higher oil weighting. So it's kind of a misleading thing, perhaps, if you look at it. If a company primarily produces natural gas, that they're not going to have as high a BOE count. So they're on a per barrel basis or whatever. So because the gas is 1/6, for 1,000 cubic feet of gas per barrel of oil. So, but in any case, the takeaway here, I think, is that generally speaking, guidance has remained pretty flat for 2025, even despite oil prices falling towards the end of the year, at least through the third quarter. Their CapEx guidance has been relatively stable. In fact, they had generally increased spending by about 1%. And so, from that standpoint, that was a little bit surprising to me. Of course, this is a lagging indicator. So when you look at capital spending guidance and things like that from companies, they're doing this sort of, a quarter after they've made the adjustment. So then that's when you learn about it, is, maybe 3 months after they've made those adjustments. That's when you're finding out about it from the public market perspective. So, I guess it's not too terribly surprising, because at that time, I think oil had been pretty stable. It wasn't really until this last quarter that we've seen about a 20% drop in crude oil prices. So it'll be interesting to see how they start 2026 off. I wouldn't be surprised to see a decrease in spending next year. How severe the decrease is will depend on the exposure of the oil and gas companies to the spot price. So for example, if companies have hedged a lot of their production at a fixed price that is above where their metrics need to be for capital spending and for their return on investment, then they'll have less of an impact. It'll have less of an impact on those companies than it will those that aren't hedged at all and are totally reliant on the spot price. And so it kind of will mix, you mix all that together. It dampens out the negative, impact on capital spending, or the drop in capital spending, in other words. So, even though oil prices have fallen, by about 20%, doesn't mean that the CapEx is going to drop by 20%. It'll be less than that, I think, probably on the order of like a 10% decrease or something like that when you look at it. And then it'll be interesting to watch if gas-weighted producers increase spending because of the increase in gas prices. As we're recording this, gas is above $4 an MCF or $4 an MMBTU. And so it's a good spot for these gas producers. And so, yeah, it'll be interesting to see how they respond to that when it comes to the capital budget process.
Yeah, you said it, Matt. It is kind of something they have to look at holistically. And, the steady increase or decrease in production has just kind of been the MO for at least a couple years with the operators. So it's not surprising. And, I think there's political pressure to continue to increase production to some degree, at least with this administration, though that may not be in massive amounts,
Yeah, I think that's a good call. But yeah, I think capital discipline remains strong, and that's not a surprise after all the bankruptcies following COVID impacts to the economy and stuff like that. So, they've learned the lesson, and they're going to continue down the path of being fiscally responsible. Returning money to shareholders will kind of be one of the top priorities for those public companies. So share buybacks are going to be probably still a priority as compared to new drilling. And so from that standpoint, they're already in a mode where they're not as levered as they have been in the past. That, honestly helps when it comes to the swings up and down as far as capital spending. It means that they're not having to make such extreme adjustments. It's just a small percentage adjustment here or there, depending on how prices, move up and down, but maybe not as much as what they had done in the past, where you saw these big swings up and down between year to year as prices went up and down. They would significantly increase and decrease spending. I think right now you'd see it more in the, low double digits in a worst case scenario. But at the end of the day, it's probably going to be closer to like a 10% or maybe a even lower than that, decrease in spending or increase in spending for those gas producers. They don't want to get over their skis too far and get themselves in a bind if prices drop. So that's the other risk that they're wanting to avoid.
You said it, Matt. All right. And rig count. So we kind of were talking before we hit record that we saw this uptick in the rig count, and it just kind of seemed like that was a blip which happened in the people trying to work out the budgets, or maybe, getting out the whatever money they had left over by completing or drilling or whatever it was. And the rig count now is showing that we've got somewhat of a decrease across, let's see, what was the total here? 6 wells in the United States?
Yeah, 6 wells in the United States, 4 of those land rigs. So we're down to 524 land rigs the week ending 12/19/2025. And that's down, like you mentioned, Justin, from the previous week. And, we had seen a little bit of an uptick in last month's report. And again, I think that's a good call. It's probably related to some capital budget, having the ability to pick up a rig or, to drill a couple additional wells. And once they're done drilling that pad out, then they would just demob that rig and then, be back to where they were. And I think we saw that with these drops since last month. And you want to go over where we see these impacts the most?
Sure, ma'am. Yeah. So it looks like we were up 2 rigs in Texas. We can start there. We saw we were down 5 rigs in Louisiana, 1 in Colorado and 2 in New Mexico, and then down 1 rig in Utah. And Matt, the formations here are what areas? The Permian lost 3 wells, it looks like. Haynesville, 3 wells. The DJ Niobrara was 1, and then the Barnett 1. So it's an interesting mix, and my mind first went to, I wonder if it's mostly oil, but that doesn't necessarily look like it would be the case.
Yeah, it looks like we saw a big drop in oil. Surprisingly, they're breaking out all of that as oil-based and none as gas. So they didn't show a change in the gas rigs. So the Haynesville losing 3 rigs, I'm not quite sure how that correlates. So there's some math going on behind the scenes in the Baker Hughes rig report that I'm not aware of. Maybe there's some oil stuff going on, maybe conventional in that Haynesville area. Cotton Valley is another formation there, although that whole area is kind of generally gassy. So who knows? I mean, it's maybe it's in the region or in that play or basin, but oil based it must have been. So not the big horizontal wells that they're drilling for gas in that area. So that seems to be unaffected. So that was interesting. So I guess not too terribly surprising. You see a drop totally in 8 oil rigs across the U.S., both onshore and offshore. And so, with the prices falling on oil side, that's not terribly surprising. It's good to see some stability from the gas side, as prices have recovered there. So
it'll be interesting to see in 2026 if gas becomes the main focus, because that's been a shift over, I'm not sure quite how long it's been, but the last couple of years, it's really been oil is where they're focusing and working on the proven plays.
Yeah, absolutely. And I think, from a mineral and royalty owner perspective, the way that to look at this is if you have both gas and oil royalties, that's a good place to be, because as in this case, oil prices have fallen, gas prices have risen. So that dampens out the effect on your royalty payments. And so you don't feel that in the pocketbook as much as if you had, say, all gas or all oil and that particular commodity fell in price, then that would have a direct impact on the royalties you're receiving. So, if you have that little bit of diversity and product mix and in terms of what you're receiving royalties on, and then even like geographically as well, as we see here in the rig report, perhaps if you have some gas royalties in the Haynesville, that's a bright spot in your portfolio, at these times when the gas prices are higher. Maybe they've doubled since last year. So your gas royalties, even though the wells are declining, you're seeing perhaps a slight increase in royalties, which is always nice when that happens. Whereas with oil, it's been kind of a difficult end to the year as far as oil prices are concerned. So yeah, just another reason I think to have a diversified portfolio. And obviously this shouldn't be construed as financial advice, get with your financial advisor to get advice specific to your situation. But, certainly diversification is king in these types of transitional periods in between oil and gas markets going up or down.
You said it, Matt, and I think there'll be no lack of news in 2026 on oil and gas prices.
That's right. So we'll keep you posted. As always, we'll link to the articles we talked about today, as well as other resources, and you can find that all at mineralrightspodcast.com. And coming up, we have our listener question episode. If you have a question you'd like us to answer in a future episode, you can send it to feedback@mineralrightspodcast.com. So with that, Happy New Year. Welcome to 2026. Hopefully it'll be another great year. And thank you again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.